Jess de Los Santos. It's the start of a new trading day, but first, let's go straight to our top story. The Banco Central would probably remain dovish and might cut policy interest rates again up to the first quarter of 2021 due to a bleak recovery outlook. That's according to analysts. Nomura Global Markets Research said rate cuts are warranted if the pace of economic recovery continues to underperform official forecasts. It said more downward adjustments from the BSP would be likely as inflation remains benign and stays within the target of the BSP, whose decisions continue to rely on data. The BSP expects inflation to average at 2.4% this year and 2.7% in 2021, well within its 2 to 4% target range. Nomura is forecasting that the BSP will slash benchmark rates by a total of 50 basis points to 1.5%, 25 basis points in December, and another 25 bips in the first quarter of 2021. Nomura's outlook comes just a few days after the Banco Central unexpectedly cut benchmark rates to a record last week, citing uncertainty due to a spike in COVID-19 cases globally and effects of the recent typhoons. The overnight reverse repurchase rate now stands at 2%, lending at 2%, and finally, deposit facilities at 1.5%. Meanwhile, Mitsubishi UFJ Global Markets Research said the central bank might also cut the reserve requirement ratio for banks or may do another round of lending to the national government. The BSP has slashed the ratio by 200 bips to 12% for big banks so far this year. Mitsubishi UFJ also said the country is unlikely to acquire COVID-19 vaccines until first half next year, which could lead to a slow recovery as restrictions remain in place. All right, Dan, happy Monday, I should say, but we are coming off a strong week with a lot of positive surprises, but will the stark reality bring the markets back to the ground?
All right, so before we go to our local bourse, let's take a quick peek at how the global markets are performing. Wall Street, for instance, is down by 0.7% for the S&P 500 benchmark, the Nasdaq as well. So a bit of weakness there on Friday. And this despite the fact that, they are saying that vaccinations for COVID-19 will hopefully start in, get this, less than 3 weeks, Jess. So you just mentioned in the banner that for us, it's going to be 2021 pa, but that might actually be happening in 3 weeks now, and this is according to the head of the federal government's program, which is tasked to actually accelerate a vaccine. Apart from that, this week we'll have a lot of movement for the US, or probably sleepiness as they celebrate Thanksgiving. That's going to be on Thursday, and then there's going to be Black Friday, which is normally the start of US shopping sales. So a lot of eyes on that, taking a look at how consumption is going to be as we start officially heading into the holiday season. Now, just a quick check on Asia Pacific. Quite mixed here. You've actually got Japan closed for a holiday today, but you're going to be seeing the other indices that are open, like Taiwan's TAIEX up by 1.2%. The Kospi over in South Korea as well, up with a strong showing. That's up by 1.5%, and over in Singapore, that's also up by 0.9%. So let's see if we're following suit, if we're following Wall Street, or we're following the rest of the Asian peers. It seems to be that we are opening in the green. That's up by 0.2%, strongly above 7,000 levels. Here we're at 7,187. That's not bad, especially as you had already mentioned. Analysts are expecting the index to correct after we saw quite a rally last week. Now, just to recall, we ended Friday up by 2.5%, and this was the best finish we've seen since February 24, and we're even above that this morning. On a weekly basis, we were also higher by 2.9%. However, I do need to highlight one thing, and that is the fact that despite this showing, the value turnovers last week were actually slowing down to 30%, by 30% rather. So we had an average of 10.4 billion, but that is still much higher than we've seen for weeks on end, where we weren't even touching 6 billion value turnovers. Another thing that's quite worrying is that we also saw a net selling of 596 million pesos. That is for the entire week. So we had all of these inflows. You can see on my chart here, the right part, those green bars, that was the week prior, and then we reversed that last week. So despite the fact that we've seen a 3-week rally, 2Trade Asia is saying that we may see a pullback this week. Another thing, however, that also brought optimism to the markets last week was the rate cut. And this is, of course, according to AP Securities as Rachel Cruz. While the full impact will not be seen on this rate cut, there was still a surprise, positive surprise, and that might shore up market sentiment in the near term. She said that property stocks will be the main beneficiary. Banks also extended gains amid that, and of course, that will reduce their funding costs, and they're hopeful that this will spur demand. I'm just going to take a quick peek at the different sectors here. Safer properties, those are down by 0.4%. The rest are actually showing quite strength here. Take a look at financials, Jess. It's close to 2% of a gain and just the first 7 minutes of trade. So very interesting here. Let's take a quick peek at our biggest movers for this morning and see whether you actually have some bright spots here. I'll just pull back to the our own PSE index there. But nevertheless, speaking of properties, while I pull out the chart, another one that is set to list for the reader, at least interested in that, is Robinson's Land. Now, this comes after, we've got Vista Land saying they're interested in it, Double Dragon finally filing that actually. And RLC is planning to infuse 15 office buildings. That's with over 400,000 square meters of leasable space. So that's picking up momentum there. And meanwhile, you can see on our boards that, as I mentioned, the banks are leading the charge. You've got SecB up by close to 3%, BDO as well. SecB had just reported their third quarter net income, surprising a lot of analysts on the upside. You've got BDO as well, Metro Bank as well in the leaderboard, but you've got some conglos here, AC and SM in particular, not really doing their share of heavy lifting this morning, Jess.
All right, Dan, let's focus on one particular stock here. One builder might have to delay some projects on the back of that tragic news accident, actually, over the weekend here in the Skyway. Tell us more about that.
Okay, so you're talking, of course, about San Miguel and that very tragic accident that's very close to home, actually. That was in the East Service Road in Kupang in Muntinlupa City. So that's below the Skyway, actually, on the southbound area. Now, they are saying that because of this accident, the toll road extension project will be delayed by about 2 months. So that's going to be, the target was December 2020. The target completion will now be February 2021. Now, you've already mentioned it, but this steel girder from that project fell on 6 vehicles. It killed 1 person and has hurt at least 4 others. There is, of course, not just San Miguel involved here. You've also got the construction company, which is EEI Corporation. They have said that together with the government, they are now conducting an investigation. And of course, worries here on how, safety measures are going to be after that Skyway accident. Now, Mr. Ramon Ang, of course, of SMC, is now vowing that apart from being investigated, they will put even stricter measures in the project site. And this, I quote his statement here of condolences and apologies to the family. I can only offer my sincerest and deepest condolences and my personal assurance that your family will be taken care of. To those who were injured, please be assured we will provide all the means necessary for you to recover and restart. SMC, just taking a quick peek at the stock movement here, that's up by 0.8%. Another piece of news, of course, juxtaposed with this is actually, Metro Pacific, which is also a toll road operator and also in the construction business. Metro Pacific's NLEX is getting regulatory approval to raise the toll rate. So this is on the other side, right? That is going northbound. That's NLEX. They've actually received the approval for an increase in toll rate effective November 25. This follows the completion of its 2.6 kilometer elevated harbor link project. projects. So what will be the damage, so to speak, for consumers here? Flat rate up by 4 pesos for regular cars, 10 pesos for buses, and 11 pesos for larger trucks. So a lot of things in focus here. Will these big conglomerates be able to maintain safety standards, and will the public, that is of course starting to be mobilized right now, be happy, so to speak, with these increases in the toll rates? Now, we've got more on markets later on in the broadcast. Jess, we've got AAA Equities as Matt Cabangon. Meanwhile, let's go back to the economic front. You've actually got one bank already dashing hopes of a recovery in 2021. What is ING Bank saying?
Okay, they're saying recession, that's likely to persist until 2021. That's as GDP, of course, contracted by 10% in the 9 months through September. In fact, you have their chief economist, Nikki Mapa, saying that they are expecting recession to actually last rather for a couple more quarters here, with trends suggesting sustained weakness across key sectors and segments here of the economy here. For one, they are pointing to signs of soft consumption, decelerating investments, and a lackluster government spending here. According to him, all these indicators actually point to the reverse of the quick turnaround officials were actually hoping for come 2021. Recall, of course, that GDP in the first quarter was revised downward to a contraction of negative 0.7%. Of course, we also had the deepest slump here in the second quarter, and then, like what we mentioned, in the third quarter, the GDP actually contracted by negative 11.5%. And recall, of course, the economic managers are still quite hopeful, of a recovery come 2021. The DBCC is expecting a deeper contraction, however, 4.4 to 6.6% for the full year of 2020. However, they are still optimistic that there might actually be recovery come 2021, and that's to the tune of 6.5 to 7.5% GDP for the full year next year. But however, you have to recall as well that is already a downward revision from their previous estimates of 8 to 9%. Now, Nikki Mapa is saying that growth is going to enter a lower trajectory, with trends pointing to a different scenario as sectors actually miss their contributions. For one, they are expecting remittances to actually drop 5 to 10% this year to a decline of $3.1 billion. That, of course, is expected to affect household spending, and that's especially worrying, according to Nikki Mapa, considering that household consumption delivers a bulk of the Philippine economic output, and the sector is expected to struggle because it's not just remittances that's actually dwindling. You also have to factor in unemployment that's also on a high. Now, in terms of capital formation, he's saying that current trends point to some stalling momentum that's after construction boom. That's after, of course, the construction boom that we saw prior to the pandemic. Now, when it comes to declining investments as well, according to him, that pretty much mirrors the trend for commercial bank lending, which has been decelerating for 5 months through August. Recall, of course, that the BSP has been doing the heavy lifting here. They did, of course, just last week, cut rates here. They have unleashed close to 2 trillion pesos into the financial system. But ANZ research economist Kanika Batangar is saying, that's really going to provide limited boost here for the economy here. According to them, weakening consumer and business confidence along with elevated uncertainty have taken precedence over the earlier priority of strengthening policy transmission. ANZ is not ruling out further rate cuts in 2021, but according to them, its effect will still be limited.
All right. Well, Nikki Mapa, they're telling it like it is. We'll have more of the news when Business World Live returns. Stay with us.
Good morning. You're still watching Business World Live. I'm Jess Delos Santos. U.S. President-elect Joe Biden's promise of tax on outsourcing businesses could dampen prospects for the BPO industry here in the country, That's according to an industry advisory firm. Biden previously floated the idea of offshoring tax penalty, tax credits for investment that creates domestic manufacturing jobs, and the shutdown of tax loopholes on foreign profits. The firm Outsource Accelerator said if this becomes a significant policy of the US government, it could have short to medium term impact on Philippine BPOs. Despite this looming challenge on the industry, the BPO sector in the Philippines remained robust even during the lockdown period. Tech hiring company Caliber noted continuous hiring activity during the months in quarantine, with more remote job opportunities made available. The company said some 50,000 to 75,000 job openings were available in Metro Manila alone, while more job seekers are also trying their hand at freelance work. Despite the robust growth in the BPO industry, Caliber noted that job posts for the Philippines in general are still down and that the rate of recovery has yet to improve. The National Tax Research Center is urging the government to widen its digital tax base by looking at digital payment systems that cover cross border transactions. In a recent study, the state think tank says the country should maximize the use of digital payments, not only for efficiency of transactions, but also to boost economic recovery. The government is urged to ensure efficient implementation of online payment systems, including cross border transactions, to encourage adoption of digital payments among Filipinos around the world. The NTRC also noted that the government should address long standing issues like poor internet connection and lack of a secure infrastructure. Tax revenues dropped by 11.28% to 1.8 trillion pesos in the first 9 months amid the lockdown. The BIR now aims to start the pilot of its electronic receipts and e-invoicing system next year.
A lawmaker is urging the Trade Department to expedite the release of stimulus funds intended to aid small businesses. This as the Bayanihan 2 law is set to expire in less than a month. House Deputy Majority Leader Bernadette Herrera D said the agency needs to ensure that MSMEs will benefit from the 10 billion peso fund allotted for the CARES program of the Bayanihan 2 law. The DTI said 8 billion pesos had already been released to the Small Business Corporation, but so far only 6,600 loans have been approved. That's equivalent to 1.2 billion pesos. 26,000 loan applications of small businesses remain pending with SB Corp. The lawmaker is calling on the DTI to push SB Corp to fast track the processing of loans and release funds to qualified MSMEs as soon as possible. Okay, with more volume and movement, it seems to be a trader's play now for the local bourse. But how much risk should we be willing to take? Here to chat with us about that and more, we have AAA Equities' President Matt Cabangon. Hi, Matt. Welcome back.
Hi, Danie. Good morning. Thanks for having me.
Hi. So, Matt, let's kick off with this above 7,000 showing here. A lot are saying it's overvalued even when you compare to pre-COVID levels. So what does that mean exactly? How can this level be justified in these markets?
Well, clearly, markets have now sort of written off 2020 entirely. Q3 earnings, while they were a bit better relative to the rest of the year, I mean, in the grand scheme of things, are still quite dismal. So investors are clearly not buying this market for a value story. I think investors now firmly have their eyes on 2021 and beyond. Because really, the prospects for this economy moving forward are positive. Obviously, right now, it's hard to see that amid all the sort of gloom and doom we're seeing. But we are seeing steady signs of economic recovery, and I think market participants are betting on a turbocharged 2021.
Now, we did expect, as you mentioned, the third quarter to be way worse than last year if you compare it year on year. But quarter on quarter, what was that like for you? Were you disappointed? Were there any positive surprises? I mean, it's still much better than we'd seen in the second quarter. And does that even tell you anything about how we're going to end in the fourth quarter, or it really is anyone's guess right now?
Well, it really is sort of anyone's guess. It's not surprising to anyone that this is a bad year. Looking at next year, we're going to be seeing phenomenal year-on-year numbers, so that shouldn't be surprising either. But anecdotally, we're seeing signs. We're seeing statements from different companies saying that they're seeing improvements. So there's better foot traffic in malls. Restaurants are picking up again. So really, the signs are encouraging. Although we can't say for certain what Q4 will look like. The only thing we can really say for certain is that it will be worse off than last year. But really, comparing 2019 to 2020 is now sort of, I guess, a waste of time, really.
Mm-hmm. But this, according to Chris Mangon, of course, also from AAA, he said he was surprised with the banks. He said that those earnings came out better than expected. Why exactly is that? Does that mean that the loan losses were not as bad in this year, or was it really because of the BSP cuts actually helping them stay afloat?
Yeah, we've actually seen a lot of net interest margins expand. So I think banks have been able to withstand the loss. I mean, banks have seen less losses than we've expected on the credit side, but also in the issuance of new loans, I guess they are still on the defensive foot. So we're not seeing the sort of credit losses that we historically see. And with a digital push, the banks have been able to cut costs quite significantly.
Mm-hmm.
Naturally, we're seeing trading gains because of the interest rate cuts. But overall, the banks are still in a kind of sticky situation because there's still a lot of unknowns there as we roll off of Bayanihan 2.
What is the upside for banks, though, moving forward? Because, like you mentioned, they've been, risk averse in lending out the loans, and that's what's making their NPLs pretty low. Once they start opening that up, and that's what they're trying to encourage, at least more lending, especially to MSMEs, which are quite risky. Will that not increase the risk?
Well, right now, the upside in banks is really from the valuation side. Our market has really run up higher and by and large left the financial sector behind. As you can see in your screen there, the returns on banks this year have been absolutely dismal. But contrast that with conglomerates. Let's take, for example, SM Investments. That share price is back to pre-pandemic highs, while their subsidiary BDO is nowhere near those highs. So now it's a question of will the greater market correct down to meet the banks, or will the banks correct higher to catch up with the rest of the market? Because I don't think the spread between financials and everyone else is very sustainable. So we're gonna have to see either one come down or one come up as we go into 2021.
And what about that related to the property space? Because property has seen a pretty good showing, at least in the month of November, and a lot were attributing that also to the BSP rate cut. But it's been such a mixed picture, because office spaces are obviously still vacant at the moment. Retail it's going to take months to go back to those levels still. Why are the stocks not? Why did you see this rally compared to the banks? Given the fact that, as you mentioned, they're still risk averse in terms of lending, in terms of consumer helping consumers pick up their spending.
Well, really, for the property sector, it really is just a interest rate story. So now that their funding costs have come down, suddenly the returns on their projects look great. But to your point, yes, rental incomes are still down across the board, although there is sign of recovery there. New residential projects aren't being taken up as fast as companies thought, or as fast as companies would hope. So yeah, there is still some trepidation on the real estate front, but clearly the market cares more about financial easing more than anything for that sector.
Okay, and what's the business case here for our property players wanting to get into REITs at this time? You know what I mean? Like, it's really like for commercial plays here. To what extent are investors actually interested in that? This for Robinson's Land or Vista Land or Double Dragon, for instance.
Yeah, I think a lot of companies now are looking at REITs to really for the tax saving purposes. So if you are a large conglomerate or a large real estate development company, and you've been sort of dragging your feet thinking about, oh, is it worth it to list the REITs? Well, right now is really the best time, just because everyone's so strapped for cash. So releasing those funds via REITs and sort of and capitalizing on those savings at this time is beneficial for companies. The only real downside is that they're going to be coming to market at a bad time, so they're likely going to get pretty depressed valuations. But I think that's the trade-off that each and every company has to look at, whether the cash flows that the REIT listing will generate will make up for the lower selling price that they're going to get on those assets.
Okay, so it's really like their need for cash right now to basically sustain their operations, and this is one avenue to do that. Let's talk about your stock picks basically right now. Are you still gonna be looking at the lockdown stock, so to speak? So in the US, we've sort of seen a reversal. You know, the Nasdaq going back into S&P 500. So the likes of Zoom, the likes of work from home stocks now being rotated, so to speak, into sectors like casinos or even airlines on the hopes of a vaccine. Is that the time to be doing the same here in the Philippines?
Well, I think for our market, everything has just run up so much and so quickly. Even airline stocks and casino stocks, which took even me by surprise, how much these stocks rallied. So clearly, the overarching story is economic recovery. And I think if you're a local investor, what you need to be buying right now are the laggards. So a stock that I really like right now is SMC, San Miguel, the largest conglomerate in the Philippines, and arguably the best conglomerate to buy if you want a very broad-based exposure to the Philippine economy. They've largely been left behind by the market rally. I mean, right now the stock's at 130 pesos. I think it has serious scope to reach 160 in the next month. So that's a stock that I particularly like, and it's clearly a laggard. Banks, I would wait until a significant move higher, just because it seems like there's just not enough confidence across the board for enough investors to be buying into that sector.
And one last point on SMC, since that was on the news, of course, this morning. I mean, does that not, make investors worried, let's say, for some delays as well in their other projects, for example, the Bulacan Airport?
I mean, what happened this weekend is of course a tragedy. It's a business and PR black eye, but again, San Miguel has seen this before. Earlier this year, there was a fire. If you remember, in their Skyway construction. So this is, I think, just part of the business when you're building projects this large. I don't think it will materially impact their ability to conduct business in the long run.
Okay, so it's more a matter of how they can actually handle the situation responsibly and move forward with their projects. Thanks so much for those insights, Matt Cabangon, AAA Equities' president.
Thank you.
And that's a first look into the business day. Today is Monday, November 23. I'm Danie, Laurel.
Catch us again tomorrow at 9:30 a.m. I am Jess Delos Santos. We are One News.